Canada added 1.2 million people in 2023. Job postings fell by 18%. That's not a lag. That's not a mismatch. That's a system that stopped connecting people to work. The country grew faster than at any point in 50 years, and the number of stable jobs being created went backward. Not slowly, not subtly. Backward. You can see it in the way job searches now feel: longer, stranger, more circular. Entry-level roles ask for 5 years of experience. Mid-career positions vanish into organizational restructuring. Interviews stretch across months, then end with silence. The resume gets open, the qualifications check out, and still, nothing. This wasn't supposed to happen. Population growth has always meant job growth. More people meant more demand, more businesses, more hiring. Economists built models on that relationship. Yet governments planned immigration around it. It felt like a law of nature, not an assumption, and for decades it held. But somewhere in the last 15 years, that link snapped. Growth continued, capital continued, credentials accumulated faster than ever. But the jobs, the stable, middle-income, private sector jobs that built the middle class, stopped forming. The pipeline didn't clog, it redirected. What you're living through isn't a recession, it's not a skills gap, it's not a temporary disruption waiting for the next cycle to fix. It's a reallocation. The Canadian economy still grows, it still generates wealth. It just stopped turning that wealth into employment. And once you see how that happened, once you see where the money actually goes now, the frustration makes sense. Because it's not your resume, it's not your degree. It's not even the industry you chose. It's that the system learned how to grow without you. There was a version of this economy that worked differently, not perfectly, not for everyone, but differently. In that version, employment was the default output of economic growth. Firms expanded capacity to meet demand, and capacity required people. Banks lent to businesses that hired. Governments collected taxes from payrolls, not asset sales. Housing was a cost to be managed, not the centerpiece of household wealth. Wages rose with productivity, and productivity rose because firms invested in tools, training, and output. The incentives pointed in a coherent direction. To earn returns, capital had to take risk. To take risk, it had to fund activity, and activity required labor. Businesses that wanted to grow had to hire, train, and retain. What workers who gained skills could expect absorption into stable roles. The system wasn't generous, it just couldn't grow any other way. This model didn't rely on heroism, it relied on alignment. Banks profited when firms expanded. Firms expanded when demand justified it. Demand grew because households earned wages. Wages grew because productivity increased. Productivity increased because capital funded capacity, not speculation. Every piece reinforced the next. Even recessions fit the pattern. Downturns cleared inefficiency and reset balance sheets, but the structure underneath stayed intact. When recovery came, hiring returned. Job markets tightened, wages adjusted upward. You could lose work and find it again because the system still needed people to function. Mid-career workers could expect lateral moves, not only downward spirals. A recent graduate circulated briefly, then settled. The timeline from education to employment wasn't instant, but it was predictable. The anger people feel now about endless applications, about being overqualified and underconsidered, didn't exist at this scale because jobs were still the mechanism through which growth distributed itself. What changed wasn't effort. What changed wasn't skill. What changed was where money goes when it wants to grow. The first mechanism that bent was housing, not housing policy. Not zoning, though that mattered, the mechanism itself, the way housing shifted from cost to asset. Interest rates spent 2 decades falling. Borrowing became cheaper. Property ownership became more profitable. At the same time, zoning restrictions and approval delays choked supply in the cities where demand concentrated. As scarcity met liquidity, prices rose faster than incomes, and once they did, housing stopped being something you bought to live in and became something you bought to hold. Returns were asymmetric. You could earn double-digit annual gains without producing anything, employing anyone, or taking meaningful risk. The investment required no innovation, no export, no output, just time and access to credit. And because gains were tax-advantaged and inflation-protected, housing outcompeted almost every other asset class available to households. Families responded rationally. Savings that once funded businesses, bonds, or diversified portfolios pooled into real estate. Equity was leveraged into second properties. Retirement security became inseparable from price appreciation. Households weren't speculating. They were adapting to the highest, or the safest return the system offered. But that capital had to come from somewhere. Every dollar directed into housing is a dollar not available to fund business expansion, equipment upgrades, or startup lending. The trade-off is direct. Housing absorbs capital. Capital no longer flows to enterprises. Enterprises stop expanding. Expansion is what creates jobs. This is where frustration starts to locate itself. Because the people who bought homes weren't wrong. They were responding to prices just like everyone else. But the aggregate effect, the system-wide reallocation of savings into non-productive assets, meant the economy could grow in value without growing in opportunity. A young couple in Winnipeg saves for 3 years. They accumulate a down payment by living with family and deferring plans. They buy a small house in a secondary neighborhood. Within 4 years, it appreciates by $140,000. That gain exceeds what either of them earned in salary over the same period. They did not work harder. They did not invent anything. They did not hire anyone. They bought an asset in a supply-constrained market and held it. That's not greed. That's rational behavior inside a distorted pricing system. But the math is unforgiving. Those gains didn't come from productivity. They came from scarcity. And scarcity doesn't employ people. It just redistributes claims on future income, banks noticed. Of course they did. Their job is to notice where returns cluster and where risk hides. Lending to businesses is complicated. Cash flows fluctuate. Industries shift. Firms fail. Even successful loans require judgment, monitoring, and tolerance for uncertainty. Under Basel capital requirements, business loans also require banks to hold more capital in reserve. That capital is expensive. It limits leverage. It constrains growth. Mortgage lending is simpler. The collateral is tangible. The borrower's income is verifiable. Default rates are low, especially in rising markets, and crucially, mortgages require less regulatory capital. A dollar lent against residential real estate allows the bank to lend more dollars elsewhere. The balance sheet multiplies faster, so banks optimized. Credit creation tilted heavily toward households and real estate. Business lending stagnated. By 2023, residential mortgages represented over 60% of total bank lending in Canada. Commercial credit, loans to businesses that hire, build, and export, was a fraction of that. Wait, not because businesses didn't want to borrow, because banks didn't want to lend. This wasn't conspiracy. It was arithmetic. Mortgages became the lowest risk, highest velocity path to balance sheet expansion. Banks fulfilled their mandates. Shareholders earned returns. Regulators saw stability. Everyone behaved correctly, but employment is not a bank's mandate. Job creation is a side effect, not a target. When lending flows away from enterprises and toward assets, that side effect disappears. The economy grows, credit expands. But hiring doesn't follow. The ledger is brutal, $1.9 trillion in residential mortgage debt. That's capital that could have built factories, funded research, expanded logistics networks, or trained workers. Instead, it paid for houses that already existed in cities where supply was frozen, and to families who paid more each year for the same square footage. And because housing prices kept rising, the model validated itself. Rising collateral values made the loans safer. Safer loans justified more lending. More lending pushed prices higher. The loop closed. Capital no longer needed production to grow. It just needed scarcity. Firms adapted too. They had no choice. Real estate costs spiked in every city where talent concentrated. Office space, industrial land, and retail locations all became more expensive. At the same time, imported goods and outsourced services became cheaper. The trade-off was clear. Reduce fixed costs, avoid labor, and grow revenue without expanding payrolls. Automation accelerated, not because technology suddenly improved, but because the cost of avoiding people finally justified the investment. Our retail shifted online, customer service moved offshore, back office functions consolidated into software. Firms that once needed 50 employees to process transactions now needed 5 and a subscription. Contract labor replaced permanent roles. Why carry the risk of full-time staff when demand is uncertain and real estate is expensive? Hiring became episodic. Projects replaced positions. Employment fragmented into gigs, terms, and temporary placements. Workers gained flexibility in theory and absorbed volatility in practice. This wasn't cruelty, it was cost discipline. Firms operate inside the same price structure as everyone else. When property is expensive and labor is variable, the rational move is to minimize labor. Growth no longer required people. It required efficiency. Productivity numbers reflected the shift. Output per worker stagnated. Firms were producing more revenue with fewer employees, but they weren't producing more value. They were extracting margin from cost reduction, not innovation. Employment became something to be managed down, not scaled up. A logistics company in Brampton used to employ 320 people in dispatch, routing, and customer coordination. Over 8 years, it automated scheduling, consolidated operations, and outsourced support. By 2024, the same revenue required 67 employees. The firm remained profitable. It paid taxes, it served clients, but it stopped being a jobs engine, and nobody did anything wrong. That's the trap. Every decision was rational. Every firm protected itself, but in aggregate, the economy learned to grow without absorbing labor. Governments tried to stabilize. They saw private sector hiring weaken and responded by expanding public employment. Teachers, healthcare workers, administrators, regulators, roles that don't generate tradable output but absorb unemployed labor and smooth political pressure. Public sector jobs are real jobs. They provide income and stability, but they don't generate the tax base required to sustain themselves. They recycle revenue rather than create it. A teacher employed by the province is paid from taxes collected elsewhere. If the private sector isn't growing payrolls, the tax base erodes even as public employment expands. This creates a fiscal loop. Weaker private hiring reduces revenue growth. Governments borrow to maintain services. Debt rises. Borrowing costs rise. Budget constraints tighten. The public sector stabilizes, but it can't replace what was lost. As transfer programs expanded in parallel, employment insurance, housing subsidies, child care credits, policies designed to cushion income volatility and support demand. Again, these aren't wasteful. They prevent collapse, but they don't reverse the underlying dynamic. They treat symptoms while the disease progresses. The result is a bifurcated economy. Public and quasi-public employment grows steadily. Private sector employment stagnates or shifts toward low-wage service roles. The middle thins. Job seekers circulate between temporary positions, benefit programs, and public postings. The pathway from education to stable private sector work, once the default route, becomes the exception. And because public employment stabilizes headline numbers, the crisis stays hidden. Unemployment rates appear manageable. Politicians cite resilience. But beneath the surface, the economy is hollowing. The jobs being created don't build capacity. They manage decline. Demographics tighten the vice. Canada's population is aging faster than almost any peer nation. The dependency ratio, the number of retirees per working-age adult, is climbing. Pension obligations are rising. Healthcare costs are rising. Tax bases need to grow just to stand still. Immigration was supposed to solve this. Bring in working-age people. Expand the labor force, generate demand, fill gaps. The logic was sound in a system where population growth led to job growth. But in a system where capital avoids hiring, immigration just adds pressure. New arrivals enter an economy with fewer stable positions than it had 5 years ago. They compete for roles that are already oversupplied. Credential recognition delays push skilled workers into survival jobs. Experience gained abroad is discounted or ignored. Engineers drive rideshare. Accountants stock shelves. The economy gains workers but doesn't gain productivity. At the same time, immigration expands demand for housing, healthcare, and services, sectors already stretched. Prices rise faster. Infrastructure lags. The fiscal cost of absorption grows while the employment benefit shrinks. The gap between population and opportunity widens. This isn't an immigration failure, it's a capital allocation failure. The people are here. The credentials exist. The willingness to work is not in question. What's missing is a system that converts labor into employment. Immigration exposes the gap, but it didn't create it. A newly arrived software developer in Vancouver sends 200 applications over 6 months. She has a master's degree, 4 years of experience, and advanced certifications. She receives 11 responses, 3 interviews, no offers. She accepts contract work at half her previous salary. The visa clock is running. She has no leverage. The system has no incentive to absorb her at fair value. The labor market doesn't care about fairness. It responds to price signals, and the price signal is clear. Labor is abundant, and employment is scarce. Here's where the mechanisms stop being separate and start compounding. Housing prices rose because capital flowed into real estate. Capital flowed into real estate because banks optimized for safety. Banks optimized for safety because regulation rewarded it. Regulation rewarded it because policymakers feared instability. Instability was feared because asset values had become the foundation of household wealth, bank balance sheets, and government revenue. The system locked. Each piece defended the next. Homeowners needed prices to stay high. Banks needed collateral values protected. Governments needed transaction taxes and property assessments to fund services. Any policy that threatened asset stability threatened everyone simultaneously. Firms stopped hiring because labor was expensive relative to alternatives. Labor was expensive because real estate was expensive. Real estate was expensive because supply couldn't expand and credit wouldn't stop. Credit wouldn't stop because the entire financial system had become dependent on housing as the primary collateral base. Higher population grew because immigration was needed to stabilize demographics. Demographics destabilized because fertility collapsed under housing costs. Housing costs crushed fertility because young adults couldn't afford space, time, or certainty. Certainty disappeared because employment became precarious. Employment became precarious because firms optimized for flexibility in a high-cost environment. Every rational decision fed the next. No villain required, just incentives, iterated across millions of actors, all responding to the same distorted price structure. And now, reversal is prohibitively expensive. Lower interest rates and housing crashes balance sheets. Raise them and employment freezes further. Restrict credit and firms can't expand. Expand credit and assets inflate more. Tax property and owners revolt. Don't tax property and infrastructure degrades. There is no lever that doesn't hurt someone who was acting rationally until now. You can see the pattern now if you look elsewhere. Japan in the 1990s followed a similar path. Capital fled risk. Banks defended balance sheets. Firms stopped hiring. Governments stabilized demand through spending but couldn't restore dynamism. Employment survived, but growth didn't. The economy aged in place. Southern Europe followed a variation. Labor markets froze, youth unemployment spiked, talent emigrated, productivity stalled. Governments managed decline rather than reverse it. Stability replaced vitality. Canada is earlier in the cycle, but moving in the same direction. The labor market hasn't collapsed. It hollowed. Unemployment remains low, but underemployment is pervasive. Job searches take longer. Overqualification is normalized. Wage growth lags inflation. Wealth concentrates in assets, not income. The system doesn't break. It just stops generating opportunity. Employment becomes something the economy tolerates, not something it requires. This is not a temporary disruption. It's a new equilibrium. Once capital finds a way to grow without people, it doesn't voluntarily go back. The options left are all bad. You can let housing prices fall. That would free capital and lower costs. It would also devastate household wealth, collapse bank balance sheets, and trigger a financial crisis. Millions of families would lose their primary store of value. Retirees would lose security. The political cost is insurmountable. You can restrict immigration. That would ease labor competition and reduce demand pressure. It would also accelerate aging, shrink tax bases, and deepen the dependency crisis. Productivity would suffer. Fiscal gaps would widen. The demographic math doesn't work. You can subsidize hiring, wage supports, tax credits, training programs. All have been tried. They work at the margin. But they don't change the underlying capital allocation. Firms still face the same incentives. Housing still dominates returns. Subsidies raise costs without altering behavior. You can expand public employment further. That absorbs joblessness and maintains stability. But it doesn't generate the revenue required to sustain itself. Debt grows. Interest costs grow. Future flexibility shrinks. You can do nothing. That's the most likely path. Manage the decline, normalize precarity, let underemployment become the baseline, protect asset values. Maintain surface level stability. Let time sort it out. The problem is that time doesn't sort it out. It just lets the pattern deepen. Capital stays where it's safe. Jobs stay scarce. Workers stay precarious. The middle class thins further. Policy isn't avoiding a trap. It's choosing which trap to spring. There are people who left, mid-career professionals who relocated to the US, Australia, or Europe, places where employment still scales with credentialing. They didn't want to leave, they wanted stable work, the system didn't provide it, so they adapted. There are people who stayed and adjusted expectations downward. They took contract roles they were overqualified for. They stopped applying for positions that matched their skills because those positions stopped existing. They moved in with family to reduce housing costs. They stopped planning for home ownership or children because the math didn't close. There are people still trying, still sending applications, still believing the next credential will matter, still assuming the system will eventually absorb them if they just improve themselves enough. It won't. The system doesn't have a skills problem, it has a capital problem. And there are people who have stopped believing in the narrative entirely, who see employment as a game rigged by asset holders, a structure designed to preserve wealth for incumbents at the expense of entrants. They're not wrong. The system does protect assets over labor. That's not cynicism. That's observation. Anger is rational. Frustration is rational. The feeling that you did everything right and still got shut out. That's not personal failure. It's structural exclusion. The jobless economy doesn't announce itself. It doesn't arrive with a crash or a headline. It just becomes normal. Job searches that take 8 months instead of 2. Entry-level roles that require senior experience, interviews that ghost, wages that flatline, contracts that replace careers, credentials that stop mattering, underemployment that persists for years. It stops feeling like a crisis because nothing collapses. The system continues. GDP grows. Stock markets rise. Housing appreciates. Banks report earnings. Governments cite resilience. But the middle class, the section of the population that once expected stable employment, rising wages, and predictable progression, has been quietly disinvested from. Not attacked, not excluded, just no longer necessary. The economy learned to grow without creating jobs. Firms learned to profit without hiring. Banks learned to lend without funding enterprises. Governments learned to stabilize without enabling dynamism. And now you live inside the result. Not a broken system, an optimized one, optimized for capital preservation, asset stability, and political calm. Employment is the variable that adjusted. You were told to get educated. You did. You were told to gain experience. You did. You were told the economy needs workers. It doesn't. It needs consumers, borrowers, and taxpayers. Workers are optional now. The frustration you feel isn't irrational. The system wasn't designed for you. It was designed for the people who already own things. And once you see that jobs didn't disappear, they were priced out, you stop blaming yourself because it was never about your resume. See, it was always about where the money goes. And the money stopped going to people a long time ago.